This is CC. It's September 7th, about midway through the trading day. Pulled up Apple here. It has been absolutely getting hammered, down 3% today. That follows a big move the day before of about, all in all, this thing's down 7% basically in the last 2 days, which is a big move for a mega cap company such as Apple. Now, the news is basically what's driving this move lower is a fight with the Chinese government. The Chinese government has expanded and announced that their employees are forbidden from using iPhones, which is a bit of a war between China and the most famous American mobile phone maker. So that's wiped out about, even in the last 24 hours, about $200 billion of market cap in Apple. As a trader, what stuck out to me is just how volatile Apple has actually been over the past month. This was the earnings move lower, if you look. This stock is 10% off of its levels that it went into earnings in early August. And it's continued to be volatile. I mean, that earnings move continued lower. Stock found buyers made a move, about 7% higher, and now it's right back down in a straight line, almost 7%. Now, when people are looking at options, one of the things they're looking for is, are options cheap or are they expensive? People dive into implied volatility and show you how it is, versus historical levels. You can do something much easier here with a stock like this, and that's look at the expected move, right? So you're seeing these 10% swings, 12% swings, 7% swings, happening in the amount of days, and if not, obviously this is weeks going back here. The options market, the expected move is basically, in order for the options market to be pricing a 10% move in Apple, you've got to go all the way out almost to year end. So this chart obviously has just gotten hammered. What a lot of people like to do is, they might step in and buy the stock here for like a quick trade, hope for a little bounce. The option. So let's look at a call spread out 8 days till next Friday, monthly expiration. Here I've got the 175, 182 and a half call spread expiring September 15th. That long strike is just below where the stock is trading, and the upper strike is, not looking for a bounce back to the highs from just a couple of days ago, just like a mild bounce back up, maybe like a 50% retracement, right? So this trade costs about $320 to make $430. What I want to point out though is, this break even of 178.20, that is, this stock is down $6 today. A very realistic level that this stock could bounce at. And this is what I'm talking about, like the options. This spread is setting up for, a way to play for an Apple bounce that does not have to be, you do not need a massive move higher. This move lower doesn't necessarily need to be completely wrong. All you need is a couple dollar bounce and you're good to go on this trade. The other thing I wanted to look at here is taking this chart out a little bit longer, right? Now, this is a pretty nasty looking chart, and it's now below the 100-day moving average. I think the 200-day moving average is about 163. That is basically the level that options are pricing out until December, actually November. So here's an interesting bearish trade, right? And I actually don't hate doing both of these trades together. So playing for a little bounce over the next week, but then looking for Apple to potentially finish a little bit lower than here into year end. Now, there's a lot of variables there, right? And if Apple's lower into year end, that means the market probably is too. So, this is a bearish market trade as much as it's a bearish Apple trade, although, Apple is the biggest loser in the Dow today. So this could be a contrarian play as well. So let's just look at this real quick, and let's go out to November. So let's just select our expiry here, November 17th. And this is a $10 wide put spread, playing down to 165, which is pretty close to that 200-day moving average. So what's amazing to me here is this is risking 3 to make 7 if the stock is $10 lower, I guess $11, $12 lower. But what's fascinating to me here is look at this break even, 172. Again, this stock is down $6 today. It was down similar the day before. It's made those kinds of moves over the last month. This is looking out 71 days, right? So more than 2 months. And all you need for this trade to work is for Apple to be less than $5 lower than what it is now. It needs to move less than what it has today by practically Thanksgiving. So basically 2 trades trying to take advantage of just how inexpensive Apple options are compared to the way the stock is moving recently. This is playing for a short-term bounce, a little bit of a retracement, and then looking out a little bit longer to November, looking for, this just to be the beginning of a move lower in Apple and potentially the market, but not really needing that much of a move to be profitable.